Nervous.
Okay, everyone, this is Rob Packard from Medical Device Academy. I just started the recording on our guest webinar today. Our speaker is Essie Pacetta. She's Director of Partnerships for Clarus R+D. I met Clarus R+D virtually through LinkedIn. Their company is a software and service company that helps small companies obtain or claim their R&D tax credits. And I will let Essie provide the rest of the details. Thank you.
Awesome. Thanks, Rob. Yep. Hello, everybody. Again, my name is Essie Pacetta. I am with Clarus R+D, and we're presenting today on the research and development tax credit, specifically how it pertains to medical device companies. So thanks so much for joining, and I hope you find the information beneficial. What we plan to go through today is a little bit of education on the R&D tax credit, helping you to determine whether or not your company actually qualifies, specifically diving into the work that you're doing and what is considered under the eyes of the IRS qualified research and development, an estimate about how much you can claim on this credit, and then specifically drilling down into Clarus R+D's process, why you might enjoy working with our company. And then at the end, there's some additional resources that we'll provide to Rob after this call. I always like to start these presentations by giving a little bit of a history lesson on the R&D tax credit. Tax credits always have a purpose that they're in place. There's always a spirit behind the credit, right? So this credit has actually been in existence since 1981. However, it's interesting that many companies, especially early stage new companies, don't know anything about it. And there's a big reason for that. Traditionally, the credit has been issued to large manufacturing companies with the time, resources, and money to claim these tax incentives. The government doesn't necessarily make it easy to claim tax incentives. While their spirit is in good nature, it's sometimes difficult to go through and make sure you're substantiating all of their requirements to claim the credit. But the entire spirit of this credit is to reward companies for investing in new technology here in the United States. So the entire caveat, the biggest barrier to entry to claiming this credit is ensuring that you are in fact spending money on research and development here in the US. And I'll go through those expense types here in a future slide.
Just to interrupt for 1 second, Essie.
Sure.
One of the things I forgot to mention at the beginning of this that I think is really important is why people that are usually watching my videos should be listening to this.
Okay.
And the biggest thing I see with startup companies is we don't have any income, so we're not filing taxes. And they look at it as a positive thing. I don't have to file taxes this year. And every single year when they want to get their small business discount for their FDA filings, they realize, oops, I should have filed my taxes, because the only proof that they're a small business is they filed taxes. So even if you have a zero income, I say, well, you could pay your accountant the money to file your taxes for a zero income or even a loss, and then you would have a tax filing that you could use to get the $9,000 discount on your FDA submissions. And that might be worth more to you than whatever the accounting fees are. And so I try to remind them of this, but oftentimes it gets forgotten. So taking advantage of R&D tax credits to offset their payroll would be an additional reason that they really should be filing their taxes and need to do it in a timely manner so they can take advantage of this. So here's 2 reasons. 1, to take advantage of your FDA small business discount. If you make less than $100 million, which all the people that are small businesses are going to fall in that category, and almost all my clients fall in that category, they're going to want to file the taxes so they can get that discount of $9,000 for every submission they do. And now here's an additional discount that they can get that's even larger to offset their payroll. Sorry for interrupting.
No, that's actually a perfect segue, Rob. So thank you for chiming in on that. What I mentioned before is, prior to 2015, a lot of companies didn't know about the R&D tax credit, because prior to 2015 and what was called the PATH Act, prior to that passing, companies actually were not eligible to take advantage of this tax credit as a reduction to payroll taxes. So you had to be a profitable company and had to owe company income taxes in order to even monetize the credit. Companies could claim the credit based on the work they were doing, but if they didn't owe any taxes, there was nothing to offset. So many companies didn't take advantage of this tax credit because it didn't help them. But in 2015, again, something called the PATH Act was passed. That's protecting Americans from tax hikes. This was a large tax bill that made a lot of changes, but how it pertains specifically to the research and development tax credit is that it permanently extended the tax credit, meaning it's written into permanent law. So it's something that if you are investing in research and development, it's never going to expire. You should be taking advantage of this credit every single year. And it affected startups. Startups are now eligible to take advantage of this credit as a reduction to their payroll taxes. So while you may not be profitable in owing an income tax yet, you certainly might have employees. And as you know, employee payroll taxes are expensive. Specifically, what this payroll tax or what this credit reduces is your company's Social Security payroll tax, which is 6.2% of your payroll. Now, the IRS does have a couple of thresholds in place to say this is how we define a qualified startup and how we define who is and is not allowed to take advantage of the payroll credit. So if you are within these couple of thresholds, you can take advantage of the credit. The first one is specifically in the tax year that you're claiming the credit. So just for example purposes, because we're in this time of year, if we're looking at what you spent in 2019 on R&D, we'd be looking also at the revenue you earned in 2019. And the IRS says if you're under 5 million in revenue in the tax year you're claiming the credit, then you are an eligible startup. And you also must have 0 gross receipts within 5 years of claiming the credit. So in this case, where we are in time, if you had any receipts prior to tax year 2015, you would not be eligible to take this as a payroll credit. But if you are still within 5 years of earning revenue, then you are eligible. If you outgrow either of these two thresholds, one or the other will knock you out, and then you do have to take the credit as an income credit. One thing to note is that if you claim the credit, it has a 20-year carry forward, both on the payroll or the income tax side. So let's just say, for example, you claim a credit and the credit is worth $50,000, but you only owe $40,000 in the tax year. You can roll that subsequent $10,000 over into the following year, and the credit will roll over quarter over quarter or year over year until the credit is used up. So 20 years is pretty generous from the IRS. Next, we go into what the IRS defines as the 4-part test. So once we've defined, okay, you are claiming the payroll credit or the income credit, then we decide, okay, is the work you're doing considered to be qualified research and development? And the way that the IRS defines that is by asking these 4 questions. So what we are going to do is ask you, the company, to substantiate the work you're doing. Now, it's very rare that a medical device company doesn't meet these 4 parts, but we still have to document it and we still have to keep it in a designated report that is specific to the research and development tax credit. So the first part of this 4-part test is there must be a permitted purpose. The technology, the medical device that you are developing must be entirely new, or in the tax year that you're claiming the credit, you must have improved upon its functionality, performance, reliability, or quality. So essentially what the tax code is saying here is that as long as you are continuing to invest in new product development or new enhancements of an existing product line, you should qualify. Number two, it must be technological in nature, meaning you have to rely upon one of the four hard sciences in order to develop your product. So those four sciences are physical, biological, engineering, and computer science. Most of you are relying on at least engineering, if not biological science, perhaps physical science, and maybe even computer science. You may have a software and hardware component of your medical device, and in that case you have a doubling down on the technology that you are relying on to develop your product. The third and fourth part of this test go hand in hand. One is that, or number three is that there must be some elimination of uncertainty. So you have to have some uncertainty around your capability to develop the product, the methodology that you use to develop the product, or the overall appropriateness of design. And the easiest litmus test to use to say, did I have some element of uncertainty, is to say, number four, did I go through a process of experimentation to solve for or eliminate that uncertainty? So the process of experimentation can be as simple as trial and error, but you do have to show that you went through a process of experimentation. Now, with medical devices, I know that processes of experimentation can go over the course of multiple years, and that's fine. You don't have to have an end result or a final product, but you do just have to show that you're continuing to go through a process of experimentation to solve for that uncertainty. If you do get through an experimentation process in the year and the result is that you ultimately failed and that you needed to abandon the original idea and go down another path, that's actually even better in terms of the IRS review of this, because that's really showing that you truly didn't know how to do something. Basically, what they're trying to eliminate here is that you're not capturing this credit on work that you already know how to do. This has to be truly innovative, and there has to be an element of uncertainty here. So when we go through and help you document this four-part test, what we're doing is helping you to answer these questions specific to the activity that you're performing. You might be thinking, okay, what exactly are the types of activities that we're working on that would be qualified R&D activities specific to the medical device space? This is just an example list. This is certainly not an exhaustive list of types of qualified R&D, but we do get the question a lot, well, does this qualify or does that qualify? And the easiest answer is if you can answer all four parts of the four-part test, then yes, it qualifies. But to kind of go into some particular and maybe real life examples for you, we generated this list for you, but again, this is not exhaustive. Medical devices, one of those areas where creativity is endless. So there was no way to encompass an entire list of qualified activities on one PowerPoint slide. So, but just wanted to give you a moment to read through these, and then we'll move on here.
I think I could probably add many things to this, but
yeah,
some people might question the element of uncertainty test, but I need to remind them that even though we do biocompatibility testing, we assume the material is going to pass, we often have tests fail for other reasons. There might have been a residue that was left on the product and somebody didn't clean it, or it wasn't sterile and there was some sort of contamination from a microorganism that caused it to fail. We also have human factors testing where we where a lot of people would, in the consumer products area, would call it a focus group, and it might be considered marketing, but in the medical device industry, it's considered research and development. And we're looking for use errors, and we often have failures, and we have to go back and change our instructions or change the way the device is designed. So there's definitely just about everything that's done in your design process for um, a, a medical device development is going to be falling into this category and be eligible. One of the questions I had, though, was when it's offsetting payroll, we're talking about things also that we might invest in, like if we hire a firm to do the testing for us, um, we can still use the money that we've paid to that firm to offset our payroll for the engineers that we have employed, correct?
Again, Rob, you're kind of nailing me on these segues. It's like perfect timing to talk about that, because the next slide is to talk about what expenses actually qualify here. So once we've defined that, yes, in fact, you do have work that qualifies, and maybe a number of different product lines that we would answer the 4-part test on, then we come over and say, okay, so how much did you spend on each of these projects in these 3 categories? And this is how we actually calculate the credit. So these are the 3 qualifying expense types, and these are what we will be looking at as we evaluate your credit. The first one is wages. So those that the money that you spend on employees and or on yourself, if you're a business owner that's taking some type of wage, whether that's a guaranteed payment or maybe some dividend based on the profits of the business, as long as you are taking a wage or your employees are receiving a W-2 and they are working directly on the product, you can capture their time as qualified research expenses. It is the percentage of time they spend working on the development. So your engineers may be spending 80% or more of their time developing the product. And if it's 80% or more of an individual's time, you can round up to their full salary amount when calculating the credits. Now, if it's an owner of a business and they're working on multiple things like general business duties, in addition to developing the product, maybe it's only a fraction of their time, maybe it's 30 or 40% of their time, but you can capture that 30 or 40%. So when you're doing kind of some of your back of the napkin math to estimate how much this credit is worth to you, those are the kind of things to keep in mind. Your engineers, as long as it's 80% or more, round up to the full salary amount. And then for you or other individuals that are supporting the engineering team or overseeing the engineering team, looking at a specific allocation of time. The second category was what Rob was just discussing. Any contracting fees that you are paying to individuals or companies that are doing third-party work to develop your product is also a qualifying expense. However, you can only capture up to 65% of what you spend on those individuals. We get the question a lot, why is it only 65%? And there's no definition or answer to this in the tax code, but our assumption is that you're not paying taxes on these individuals. So, you know, the IRS is cutting down on that expense a little bit. Ideally, they want you to hire people to do this work, right? And then in addition, you know, there's no way to track their time as closely as you can track employees' time. So to account for, you know, some of the gaps in time tracking, perhaps, you know, they've cut it down to only allowing you 65% of that expense. The other question we get is, can we include patent attorneys? And I would largely the answer is no. Any service provider who is an accountant, lawyer, you know, patent attorney, those largely are not going to be qualified contracting expenses here. We're really looking for companies that you've outsourced to that are specifically working on the development of your product. And then the last part that I always like to emphasize here is that these individuals or companies need to be physically doing the work located in the United States or on a US territory. So sometimes we get the question of, well, the company is located in the US, but we know that the individuals working on our product are overseas. In that case, you may be able to quantify some portion of that expense for the individual in the US that's overseeing the individuals overseas, but largely that's an expense that won't qualify because the work has to be physically done here in the United States. And then the third qualifying expenditure is supplies. And when we're thinking about supplies, we're thinking about supplies that are non-depreciable and tangible that are used up or consumed in the process of development or experimentation. Obviously, if you guys are creating medical devices, you have tons of prototype materials. This is a prime example of the type of supply cost that you can quantify here. Where we really need to separate the supply costs is the supplies that are used in production for end products. Those cannot be captured, as well as any machinery that you purchase. Machinery is not a qualified expense because it's an asset to the business subject to a depreciation schedule, so cannot capture that as a qualifying research expense. But anything that, again, that is used up, consumed in the process of experimentation is what's going to qualify here as a supply cost.
Hey, see, this is Sanjay. I have a question. So let's say if we are using cloud resources for our experimentation, so we are building a software AI product. It's like a software as a medical device, and we are using cloud resources and spending money on our experimentation. Would that be considered as supplies?
Yes, and thank you so much for bringing that up, Sanjay. I failed to remember that there's probably a number of medical devices that rely upon computer software. And yes, absolutely. The one exception to the tangible rule is for software that you subscribe to, such as AWS, Azure, GitHub, Jira, to the extent you use Slack and certain Slack channels to communicate between developers. Things like that would certainly be qualifying software supply costs.
Okay, and like, is there any percentage associated with that cost?
Yeah, it's the full 100% of those supply costs. So the only time you would break down a supply cost is, like, let's just say, for example, using the AWS example, if you're using AWS for production or hosting, you couldn't use the entire AWS cost towards development. So you really have to decide, how much of AWS is used for the development of our product versus production and, end product use.
Okay, got it. Okay,
Yeah.
If just to see if I understand that correctly, first of all, almost 100% of my companies that I work with have software either in their product or they use it in their quality system.
That's good to know.
And that trend is growing to a larger and larger percentage of devices are either monitored or communicate with mobile devices, so they have software for those reasons.
Mm-hmm.
But when companies are trying to make a decision on whether they should buy a $40,000 piece of quality system software, many of them aren't aware that that might be deductible, or at least part of it might be deductible.
Mm-hmm.
And one of the companies I work with has two different versions. They have one software package that's just designed for documenting their design history file and all of the research and development efforts they do. So 100% of that software is used just for research and development. Whereas their quality system software, only part of that software is used for research and development. Whereas it would be less than 20% probably is used for research and development. So same company providing software to companies, but one software is used 100% for research and development, and the other one less than 20% of the time it's used for research and development. and documenting how much would be fairly easy based on the amount of records and that you have in the system. But I hadn't even thought about supplies including software, so that's a great eye opener, and that could definitely offset some of the costs of implementing that software.
For sure. So kind of to wrap up this slide, to understand how much this credit is worth to you, what you would do is, and this isn't the math to actually calculate the credit, this is just the math we use to estimate the credit. What you would want to do is add up your wages, your contracting, and your supply costs. Of course, taking the contracting fees down to that 65%, and taking it at 10%. 10% of the sum of your qualified research expenditures is what the credit will be worth to you, and what can be used to reduce those payroll taxes on a quarterly basis. One thing to note here is that any research that is funded cannot be included as a QRE. And what I mean by that is, I know a lot of medical devices companies receive grants, and if you do not owe or have any obligation to refund that grant money, then that's essentially money that was used at no risk of yours, and so we have to eliminate that from the calculation of the credit. So that's important to note. But generally speaking, what you spent on research and development in these three categories, you receive 10% of that back from the government. Yay. So how do you actually get the money? That's the biggest question that we all have, right? So our process at Clarus R+D is such that after we engage with you for the work to do the study, we have what's called a kickoff call. On the kickoff call, we're going through a full demonstration of the software, and you're also going to be introduced to your dedicated tax credit specialist. This is somebody who's actually going to be reviewing the information that you supply to us on the back end. It may make more sense to actually go to the next slide before I hop back to the other one and let you know that we are a software company. So Clarus R+D provides software in order to collect all of this information on the front end. And you can sort of think of it like a TurboTax-like solution. So it's asking you a series of questions that are well-defined and that are guided with examples along the way to help answer these questions that we need to collect to substantiate the credit for you. So you'd be answering questions like the 4-part test, you'd be supplying us with your qualified research expenditures, and you'd be backing those up with supporting documentation like wage reports or invoices, etc. So that's what your front end experience would be like with Clarus R+D. That process typically takes companies at your stage 2 to 3 hours maximum. This is all information that you likely already have documented somewhere, but we need to aggregate it into one central location. Additionally, we're offering you pricing that fits. We are generally charging about 20% of what the credit actually is worth. So that's kind of how our pricing works. Additionally, we're partnering with your CPA as well as your payroll provider to make sure that the credit is claimed properly. So let me touch on this a little bit. For your 2019 tax credit, for example, in order to claim the payroll credit for 2019, you need to include the R&D tax form that we prepare for you on your 2019 tax return. If your deadline passes and you don't have this tax form on your tax return, you miss 2019 altogether. You cannot go back and amend this tax year to claim the payroll credit. So it's a use it or lose it. Again, going back to what Rob said at the beginning, this is a big incentive to file your taxes. Once you file your taxes and include that tax form on your tax return, you can begin claiming the credit to reduce your payroll taxes in the following quarter. That's where we come into play to partner with your payroll company. So we're taking the information that we gathered through the study that we did for you and the calculation of your credit. And we're working with the payroll provider on the back end to make sure that you're claiming that credit quarter over quarter. In case this, is something that you do not know or are slightly unfamiliar with, your payroll company is likely the ones impounding your taxes on a per pay basis and then remitting those to the IRS on a quarterly basis. Payroll taxes are due every quarter. So if you claim a $60,000 tax credit, but you only owe $20,000 in the quarter, then you'll get $20,000 back from the IRS every single quarter until the credit is used up. So that's how it's used and that's how it's monetized. And it's really important that whoever is doing this work for you monitors and makes sure that the payroll company is actually giving you that money back. Every payroll company processes this credit differently. We work with almost all of them, and we know the right people to speak with when, companies aren't receiving their money. Let's just put it that way. So when we say we have a true partnership, this is really important to kind of touch on. And then the final piece here that we also like to touch on is the documentation of this credit. There are companies and or smaller tax preparers that will simply take a look at your qualifying R&D expenses, calculate the credit, throw it on a tax form, and claim the credit for you. But if you're not documenting and properly substantiating your credit and ensuring that you've met the 4-part test, ensuring that the expenses you're claiming are truly qualified R&D, then you're subject to audit. And if you are audited and if you don't have that contemporaneous documentation on you at the time of audit, you're going to have to owe your credit back, and then you'll also be subject to fees and penalties, and nobody wants that. So it's really important that you're doing this study correct and right, and that's what we help with. So hopping back to this slide again, how we kick off our studies is, again, with a kickoff call, and this is with your tax credit specialist. This is a dedicated individual that'll be working with you on your study, and they'll go through an in-depth demonstration of the software, and after that call, you'll have access to the software. You'll begin entering your information. Again, this part takes about 2 to 3 hours of your time. Once you submit that back to us, that's where the real work begins for Clarus R+D. And again, it's ensuring that all of your answers meet the 4-part test, meet the IRS guidelines, that there's case law or precedent in place to make sure that this is qualified R&D and this is qualified research expenditures. And then the end product is, again, that Form 6765. That's what needs to be included on your tax return, as well as a full study documenting that we've properly quantified your R&D activity, that we've properly calculated the credit, and that we've properly captured the R&D expenditures. And then the final step is obviously claiming the credit. So that's the exciting part, and that's when you can begin really monetizing the credit, is that quarter after you file your tax return. Another incentive to file on time and early is to start receiving that money earlier in the year. So that really wraps it up. We just wanted to kind of touch on briefly here, that we're a startup ourselves. So we've actually been in business since 2016, right after the PATH Act passed. But since then, we have served over 300 clients, earning over 15 million in R&D tax credits for our clients. We are founded by a couple of veteran CPAs, as well as a technology startup guru, and we have really, really awesome clients that have some great things to say about us if you want to check out our website and read any of our case studies. But this is my contact information. Of course, feel free to reach out to me directly, and then I assume you'll get a copy of this presentation after the call, so you can easily go to that link and schedule an appointment directly with me, or just reach out to me directly and we can set up a time to talk about your specific situation for the credit.
Thank you very much, Essie. There's
You're welcome.
actually going to be 2 ways that everybody receives this presentation. Number one, they'll receive a hyperlink in an email for them to click on so they can download it directly from our Dropbox website. The second way that people will be able to access it is we will post a version of the recording on our YouTube channel, so people that are subscribing to the YouTube channel can view it there as well. So there'll be 2 different places. If at a later date we have a blog post on the website, we could also potentially put a link there or embed it in there if you would like. But we'll talk more about that with Clarus R+D after we get the recording and people get a chance to look at it. I really appreciate this, and I have a number of clients that I could see could have taken advantage of this in the past years, over the last 4 or 5 years, and I have some clients right now that I'll be sending out emails to, sharing the link with them, because I know that they are not aware of this. I've already gotten some people that said that they were not aware of this and thought this would be really great, including one is a company that makes one of those software packages that I was talking about, and they thought it was a really great idea as well. So I'll have a couple of people that you can talk to afterwards that would really like to share this information with their clients.
That's great. Thank you so much, Rob. And Sanjay, thanks so much for joining. Let me know if you have any questions.
Yeah, if any, I don't, we have so few attendees on this live session because we didn't have a lot of time to promote it. I don't have anybody showing up questions in the chat box, but if you do have questions, just email myself or Essie at the email address provided on the screen here. I don't think we have anything else, so I can let you go. And as I said, after we finish the session, it'll compile the recording and I'll share that with everybody.
Sounds good. Thanks so
Thank you
much.
very much. Have a great day, Essie.
Bye.
Bye-bye.
Thank you.